and then a new prepaid will replace it. And so from the other perspective, we get cash at $2,500. We would have reduce our lease receivable by $2,000, and then the $500 is going to be a payable. Maintenance payable. In other words, as they then have to expend things to do the maintenance, they would reduce this liability. Credit cash, reduce the liability. Okay, so let's just think for a second, what would happen at the second payment? So here's our second payment, right somewhere, right here. Nope. Here's our second payment right here. The only difference would be with credit cash $2,500, debit, what would we debit here?
Lease.
It's going to be
Lease paid.
the maintenance expense. So you could also call this a prepaid and then do another journal entry that gets rid of the prepaid and make maintenance expense, or you could just lump them all together and just debit maintenance expense would do the same thing. Does that make sense? And same thing here, credit cash $2,500. Debit cash $2,500, credit maintenance expense. This would be not the payable, instead it would just be, well, it would probably be the payable in this case, because you're not actually paying for anything right now. Does that make sense?
Did you not do an adjusting entry at the end of the year, at the end of 2011?
Yes.
And then do January 1's payment?
Yes, you would. Yeah. That is correct. That is what you would do. And that's probably why I only did the first one, so I didn't have to deal with that. But I made it December 31st after. So it's actually different from that one in that it was paid the day before. Yeah, so yes, you would have to do an adjusting entry for those expenses to keep them in the right period. So you are correct. And if we had more time, I would love to do a whole problem with this. Well, we don't have time. So I apologize.
Is there one like this in
There is. Yep. And the textbook also has an example. So you have those examples. All right, so a couple other details, and then we have one more problem that we have to work through, and it's a full problem with the sale and lease back. So I think what we'll do is we'll deal with all of the smaller issues first, and then we'll do that problem last, if that's okay with everybody. All right, so discount rate. A lessor's implicit rate is the effective interest rate the lease payments provide the lessor over and above the price at which the asset is sold under the lease. It is the desired rate of return the lessor has in mind when deciding the size of the lease payments. Usually the lessee is aware of the lessor's implicit rate or can infer it from the asset's fair market value. When the lessor's implicit rate is unknown, the lessee should use its own incremental borrowing rate. When the lessor's implicit rate is known, the lessee should use the lower of these two rates. This is the rate the lessee would be expected to pay a bank if funds were borrowed to buy the asset. All right, so in all of our examples that we've done so far, we've said this is the market rate of interest, and there's just one. In actuality, the lessor is going to say, all right, this is the return we expect from this lease. And so this is what we're basically going to charge. And so that's what they use to figure out what the payments are going to be. The lessee then looks at this and says, all right, I can figure out what interest rate they are using, the implicit interest rate they're using to come up with these payments. Why? Because I know that these are the payments, and I know this is the value of the asset right now, and I can figure out what that interest rate must be. If they can figure out the implicit interest rate, which is almost always the case, you take that, compare it to what the interest rate for the lessee is, take the lower of those two, and that's the interest rate they would use to figure out the present value of the minimum lease payments. This is what happens in real life. On the exam, we're just going to deal with one. Simplify. So one interest rate is all we're going to deal with. But in real life, there's the potential that the lessor is using one interest rate and the lessee is using a different one. That is that possibility. If the lessee's interest rate that they're borrowing is less than what they're getting from the lessor, then the lessee's interest rate that they use to discount things is going to be smaller than what the lessor is using. So there is that possibility, you need to be aware of that. And occasionally that makes it so that one person is using a capital lease and the other person is accounting for it using an operating lease. So it's possible that neither of them have the asset on their books, or both of them have the asset on their books. Isn't that fun? Makes no sense. But that is the way, and it's rare, but that is a possibility. All right, direct costs. And I know I'm dumping a lot of you around at the very end. If we had another class period, it wouldn't be like this, but it is what it is. Direct costs. Initial direct costs are the costs incurred by the lessor that are associated directly with originating a lease and are essential to acquire that lease. Okay, so we're the lessor, and there are things we have to do to be able to lease something to someone else. We have to pay a lawyer to write up the contract, the lease contract. What else? We have to make sure that the person we're leasing this to is credit worthy. So there's costs associated with that, just the document costs. So there's some costs. Oh, so here's some examples. Legal fees, commissions. So if you have a salesperson, you have to pay commissions. Evaluating prospective lessee's financial condition. I just said that. Preparing and processing lease documents. So these direct costs, which are very different than executory costs, but direct costs are costs for the lessee to get the lease. You can't have this lease without these direct costs. Sometimes they're called initial direct costs. The method of accounting for initial direct costs depend on the nature of the lease. Okay, here we go. For operating leases, initial direct costs are recorded as assets and amortized over the term of the lease. Since the only revenue an operating lease produces is lease revenue, and that revenue is recognized over the lease term, initial direct costs also are automatically recognized over the lease term to match these costs with the rent revenues that they help generate. All right. So for operating leases, your only revenue is as time passes. Therefore, you take these costs, and instead of expensing them all immediately, you spread them over the life of the lease to match those costs, those expenses, with the revenues. Does that make sense? Okay, that's an operating lease. They get spread over the lease term. For capital leases, we have two different types. We have direct financing and we have sales type, and so we'll talk about each of those. So in direct financing leases, interest revenue is earned over the lease term, so initial direct costs are matched with the interest revenue they help generate. Therefore, initial direct costs are not expensed at the outset, but are deferred and recognized over the lease term. This can be accomplished by increasing the lessor's lease receivable by the total of initial direct costs. Thus, as interest revenue is recognized over the lease term at a constant effective rate, the initial direct costs are recognized at the same rate, that is proportionally. Okay, so in other words, with the direct financing, there's no revenue immediately. So just like with the operating, we're going to spread those expenses across the lease term to match the revenues with the expenses. The proportional part is saying that you're going to have more revenue in certain periods, and so you're going to match the expenses proportional to when your revenue is going to be recorded. And then last but not least, for sales type leases, initial direct costs are expensed at the beginning. Why? Because you're going to record revenue immediately. Since the usual reason for a sales type lease is for a manufacturer or dealer to sell its product, it's reasonable to recognize the cost of creating the transactions as a selling expense in the period of the sale. So for sales type capital leases, direct costs are expensed immediately. For the other two, they're spread over the life of the lease. Does that seem reasonable? There's going to be a multiple choice question that asks about this. So prepare yourself for that. Contingent rentals. Sometimes rental payments may be increased or decreased at some future time during the lease term. Depending on whether or not some specified event occurs, contingent rentals are not included in the minimum lease payment. Instead, contingent rentals are disclosed in the notes. That's easy, right? So if there's the potential for so sometimes, and this happens with leases for apartments, sometimes if something changes, so for example, if the interest rate reaches a certain point, or if some other, economic event happens, then the amount of the lease payments are going to change. So sometimes, if interest rates go up, then lease payments go up, or potentially down. That rarely happens, but that's a possibility. And so if we have these contingent rentals, you don't include that information when you figure out the minimum lease payment or any of the accounting, unless it actually happens. Obviously, then you change it. Instead, you just disclose that information in the notes. That sound good? Everyone's brains full? Well, we got to find a little more room in there. We got a couple more things to do. Sale and leaseback we'll come back to. I'm going to do the other short things real quick first. Real estate leases, who cares? All right, big X through that. Leverage lease, who cares? Big X through that. IFRS, I will just mention briefly. I'll let you read that on your own. The only thing I'll mention briefly is that the accounting for leases internationally is very similar. Most of the things we've talked about are the same. The big two differences, and there's a couple other nitpicky differences, but I'll just describe the two big differences, is that you remember the 4 criteria for determining something as a capital versus an operating? They don't have those 4 things. Instead, they just give you a principle and say, if risks and rewards transfer, they don't call it a capital lease, they call it a finance lease, but essentially it's the same thing. It's a finance lease. If they don't transfer, it's an operating lease. So instead of giving very specific rules, they just give a principle. And then they say, you'll probably want to consider, if there's a bargain purchase option, you'll probably want to consider what portion of the lease term is being used up. You'll probably want to consider the present value of the minimum lease payments compared to the value of the asset. You'll probably want to consider if the ownership transfers, and then they give you like 6 other things. But then they just say, risk and rewards transfer, finance lease. Don't transfer, operating lease. So it's basically no bright line rules under IFRS. The other big difference, I guess it's not that big a difference, is they call it a finance lease instead of a capital lease. Same thing now. There are a couple nitpicky differences with regard to the options associated with additional lease terms, which we won't talk about in here, we'll just ignore. And then there's a little bit difference with the bargain purchase option, which we'll ignore as well. The only other thing I'll say is that the lease, all this stuff that we've just done with leases in the last 2 days, all this fun we've had with the leases, may change here in not too long. There is a current proposal that both the ISB and the FASB are working on. That they're trying to change lease standards. Lease standards are broken because everyone is using off-balance sheet financing, and it's very inappropriate to not have assets that the firm is using to create revenue with, and none of them are on their balance sheets. The proposed standard, instead of using the risks and reward principle that we've basically talked about through this entire thing, instead of using risk and rewards, they use something called the right of use. And the basic idea is whoever has the right of use to this asset must put it on their books. So as a simple example, if we have an asset that's going to be useful for 10 years, if the lessee is going to use it for 7 of those years, they're going to put 7/10 of the asset onto their books. The lessor is going to put the other 3/10 of the asset onto their books. So the asset's going to be split between the lessee and the lessor according to who has the right of use of the asset. Now that is at least part of the current proposal. If you were to ask me a year and a half ago, I would have said that's what all leases were going to look like. Well, now they've backed up and said operating leases are back. And so some leases are going to be different. They're still going to use the right of use for the capital/financing lease, but they're currently talking about having an operating lease again. Not everyone's real excited about that, but that's where it currently stands as of 2 weeks ago when they last met. So, there you go. And then last but not least, one more example of a lease. a sale and leaseback. All right, so in a sale and a leaseback, the owner of the asset, so I own the asset, I sell it to somebody else, but I want to keep using it. So then I lease it from them, and I'm using it again. So I no longer own it, someone else owns it, but I'm still using it. That's a sale and leaseback. I sell it to somebody, and then I lease it from them, and I continue to use it. Does that make sense? It's a sale and leaseback. So first of all, why would anyone ever want to do that? It actually happens pretty regularly. So there's obviously a reason that firms are doing it. So here's at least a couple ideas. This is probably the most common reason, is that if interest rates fall, and let's say for example that we borrowed money to buy this asset, well, we could refinance it by paying it off and refinancing, or we could sell it to somebody and get that cash, repay our financing, and then when we lease it back from them, we're going to get the current interest rate. So that's one way of basically refinancing an asset. So that's a common reason. Another reason is if you just have the need of the cash for something else, and for whatever reason you can't borrow the money, which is kind of a rare thing, but if you have really bad credit for some reason, you can basically sell this thing, get the cash, use it for whatever you need, and then just make cash payments when you have to for the lease. So that's a potential other reason. The first reason is probably the biggest reason why firms would do it. Any gain on the sale of the asset is deferred and amortized. So if you sell it to the person and you would record a gain from that sale, you can't record that immediately. You're going to amortize that over the lease term. A real loss in the sale of the property is recognized immediately. So a gain is amortized, a loss is recorded immediately. The lease portion of the transaction is evaluated and accounted for like any other lease. So you sell it to them, and then the accounting for the lease is like any other lease. So there's really no difference there. So the interesting part, or the reason that this problem is different from the previous ones, is we have to deal with the sale at the beginning, and then we have to deal with the amortization of the gain, if there is one, over the life of the lease. So those are the two new things that we're dealing with here. A bunch of the rest of this is going to be the same as what we did previously, but is a nice review of some of the things we've already done. So here's our example. Just enough time. To raise cash, Guyman Inc. sold a stump grinder to Blunk Corporation. So Guyman owned it, sold it to Blunk at a price of $9,985, and immediately leased it from him. So Guyman is still using it. He used to own it, he sold it to me, and now he's leasing it from me, and he's still using it. The asset had a book value of $7,000 on Guyman's financial records and an original cost of $12,000. We'll need that because we need to take it off of his books. The lease agreement specifies annual payments, sales date and inception of the lease, and each December 31st, 2015. That's what useful life of the grinder, 7 years. The interest rate for financing the transaction is 8%. So I tried to make this as close as I could to that very first one again, the direct financing one. So it's very similar to that one once again. And so this is going to be a direct financing, and in fact, do I have this on here? I'm pretty sure, I can double check, but I'm pretty sure that all sale and leasebacks well, I might be wrong, so I'm not going to say what I was going to say. All right, so pretend like I just didn't say all that because I don't want to say something that's wrong. All right, so here we have this lease, and so the first thing we need to do is we need to deal with the sale part of it. So we'll deal with the sale, and then we'll deal with the lease part of it. So for Guyman is selling it, and so he's going to sell it to Blunk. And so Guyman is going to receive cash, and it's going to receive cash of the $9,985. That's how much they're selling it to him for, $9,985. We're going to leave a little room because we're going to have another debit here in a second, but we're going to do a credit. We're going to get rid of the property, plants, and equipment. of $12,000 that's on our books. We need to get rid of the accumulated depreciation associated with that property, plant, and equipment. And it says it has a book value of 7. So what's our accumulated depreciation? It's going to be 5, right? Because the 12,000 minus the 5 is the book value of 7.
Thanks.
Does that make sense, everybody? And then we're going to have either a gain or a loss on this sale, because the value of this asset is different than what our book value is. In this case, we have a gain. Can we record a gain right now? No. So instead, we have a liability called a deferred gain. Kind of like an unearned revenue, sort of. And it's going to be the difference, which is going to be $2,985. All right, so this is our sale. And we will do the journal entry for the lease in a second. The lessor for the journal entry for the sale is that they're going to give up cash of $9,985, and then they're going to get a piece of equipment, and we'll just call this property, plant, and equipment for them. $9,985. So that's the sale. That's the whole thing for the sale. Nothing else needs to be done for the sale. Now we'll do the lease part. The lease part is going to be basically the same as what we've done previously with the direct financing lease. And in fact, this is a direct financing lease. The thing I was going to say earlier that I'm not 100% sure on is that all sale and leasebacks have to be considered direct financing, but I'm not 100% sure on that. Pretty sure. 75% sure. So we'll go with that. That's what it always has to be. In this case, it certainly is.